Here we are back to talk about the second most common type of financial statement fraud, and that's inventory fraud. And inventory fraud is a great two for one when they commit this, because you're also getting some impact on your cost of goods sold. Let's review some basic accounting. All right, so we know that beginning inventory plus purchases minus cost of goods sold equals ending inventory, right? So we call beginning inventory plus purchases goods available for sale minus cost of goods sold equals ending inventory. And of course, by the same token, using a little algebra, flipping that around, beginning inventory plus purchases, or goods available for sale, whatever you want to call that, goods available for sale minus ending inventory equals cost of goods sold. So you can see that if you're overstating cost of goods ending inventory, you're going to end up with an understated cost of goods sold, right? Because if you're subtracting too much here, then this is going to be too small. So you're getting a great benefit when you overstate inventory. You get a great benefit on your cost of goods sold, which is an expense on the income statement. So you've got the bonus, you've got an asset that looks higher than it really is on the balance sheet, and on your income statement you've got that cost of goods sold that looks smaller, right? So when your cost of goods sold looks smaller, your net income looks higher, right? So those are the two ways you can mess with net income, correct? Because that's the bottom line. When they're committing these financial statement fraud, they want their earnings per share to look higher, so they need the net income to look higher. There's two ways you can get to higher net income: increase the revenues, which we already talked about, or decrease the expenses, which we're going to talk about now. The expense they can most easily adjust is cost of goods sold, right? Because that's internal. Other expenses, your selling and admin expenses, well, somebody needs the rent to be paid to them. You can't really mess with that. Salaries need to be paid to the employees. You can't mess with that. You can mess with any of this stuff, right? But it's harder. It's very easy to just inflate your inventory and make your ending inventory look higher, and that's going to make your cost of goods sold look lower. So win-win. All right, so this next slide is just kind of reminding you of what I just told you, right? When you have too high of ending inventory, your cost of goods sold is going to look too low, right? So revenues part's not affected at all. That was last video, revenue. But cost of goods sold, if your inventory is overstated, your cost of goods sold is understated, which means, right, gross margin. Gross margin is revenues minus cost of goods sold equals gross margin. So if revenues are the same, cost of goods sold is too small, well, then gross margin or gross profit going to be overstated, right? So then you take out your other expenses that you haven't messed with, and that's going to leave your net income overstated. So really nice, right? So if the end of the period is overstated, cost of goods sold, understated gross margin. Now this has a double period effect, right? Because let's look back here, right? Beginning inventory plus purchases, so goods available for sale minus ending inventory equals cost of goods sold. Well, the beginning inventory, right, the ending inventory from this period is the beginning inventory of the next period, right? So it's going to carry over. If your ending inventory is overstated today, well, tomorrow's beginning inventory is going to be overstated too. So what does that cause happen, right? So beginning inventory is not affected the first time you do it. It's your ending inventory that's affected. But now next period, your beginning inventory is overstated, which means goods available for sale is overstated, and now cost of goods sold is overstated. So you're having a double period effect. All right, so gotta watch out for that. So if they're messing with cost of goods sold by inflating the asset inventory, how do they get that inventory inflated? Well, they just double count it. They capitalize costs that should be expensed. So you can so your inventory number, right, is your comes from everything that went to make that inventory. So it's not just what you paid for something, right? It could have some labor in there. It's cost to make ready. So you can call something overhead and include it in there. Cut off, just putting it in the wrong period, just like you can with revenue. Overestimate, bill and hold, and consigned inventory. People do sometimes count inventory as theirs, even though it doesn't really belong to them. All right, it's been consigned to them. All right. So, in order for us as fraud examiners to be able to identify inventory-related fraud, we have to figure out, okay, where is it most likely to occur, right? At my client, I'm going in to look for inventory fraud. Where is that going to happen? How are they going to do that? And in order to understand that, I need to understand the inventory process. How does inventory work at this client? So obviously, if they're retailer, they purchase it. If they're manufacturer, they're purchasing raw materials. Believe me, inventory fraud can start in the raw materials phase. Okay, it can and work its way all the way through work in process out to the goods available for sale, finished goods inventory. So purchasing inventory could mean purchasing raw materials inventory. Or you could be a retailer like Walmart and you're purchasing actual inventory that you're going to turn around and sell. Purchase it. Do you return some of that? Yes or no? So there's a spot. You could return it but not say you returned it, right? Take a discount, right? The discount, if you take a discount on a purchase, that's not part of your inventory, but if you don't subtract it out, it could be part of your inventory. You pay the vendor. If you sell it, you have to ship it, right? If it becomes obsolete, you have to write it down. You can't keep carrying your inventory at its cost if you can't sell it for that, right? You have to go to lower cost or market. You have to, if inventory is something you can count, then you go count it periodically. If not, you estimate it using weight. I mean, you can weigh things like that, measure things. There's ways to estimate inventory. And then you determine your inventory costs at the end. So you can see all along the way, right? So down here, you may have to include some overhead, some extra stuff. So there could be some more steps depending on how your inventory at your client works. So there's 9 different transactions that affect inventory in general. And this next table shows the accounts and how fraud schemes might work, right? So in the purchasing time, you understate your purchases. You record purchases too late. You don't record the purchases. When you return it, you could overstate returns, right? So pay vendors, overstate discounts, do not reduce inventory. Record it too low an amount, do not record cost of goods sold, so it's not recording your transactions. Don't write off your obsolete. So you have this obsolete inventory, you know you're never going to sell it, but you don't write it off. GAAP says you have to write it off. It can't be part of your inventory. But now that's going to overvalue it. You overestimate it, double count it. Again, some inventory, like it's easy for us to think of stuff like at Walmart, and it's got a SKU, and you can go use your little gun and get that SKU and type in how many there are of that. But some inventory is not like that, especially raw materials inventory. It might be a giant pile of sulfur and iron and coal, so you have to estimate how many tons do I think is there. So that's easy to overestimate. Capitalize amounts that should be expensed. Capitalizing means you turn something into an asset. So you make a purchase, and instead of taking it as a selling or admin expense, you say, oh, that was part of getting my inventory ready. That's overhead. That goes in my goods available for sale number. So you can do that, make just fake stuff, right? All right. So now that we understand how inventory works, now we can start looking for symptoms. So in our next video, we're going to understand what symptoms we might see to tell us there's something wrong with the inventory number.